Hello, everybody. As promised, I'm doing a short video announcement for you to kind of wrap up what we've been working on and lead into the final exam. The last chapter that you all have been working on is accounting, and we went through that pretty fast in class, so I did want to talk about a few highlights there to make sure that you're feeling prepared as you move into the end of our course. One of the most important things that you will want to take away from the accounting chapter and accounting in general is this accounting equation. Everything that you do in accounting is built around it. So it's important to understand it and to know what it means. So again, if we look at the equation, let's take a quick look at the terms within it. Assets are those things that have value that are used to fund your operation. So assets can be cash, they can be material, inventory, they can be equipment. So in our lawnmower example that your book also used, it could be the lawnmowers themselves, it could be cash in the bank, etc. Then the other side of the equation, notice the equal sign, signifies how those assets, those things that have value in your business are funded or financed. So there are two ways that we can do this. We can either borrow money or we can put the owner's money in other words, our money. Owners, first of all, can either be a single person, as in somebody who owns a small landscaping business, or it could be millions of shareholders who own stock in a company. Because when you purchase stock in a company, you become an owner and you have an ownership piece of that company, and that's called equity. You can also borrow money, and that's what a liability is. Liability is a synonym for debt. So it's something that you owe other people. Now, for instance, you could owe money to your parents, you could owe money to a bank, you could owe money to an investor if the terms of the money that you received mean that you have to pay it back. So there are a variety of places you can get financing for these items that you need to make money in your business. And again, the assets are these items of value, and they are used to create profit within your organization. So I hope that makes a little bit more sense to you. From that equation, we can build three primary financial statements. There are other financial statements that you will get to know if you spend more time in accounting, but the three basics that as a business manager or owner you really want to be aware of are the three that are on your screen. We use these statements to organize our information, our financial information about our business, so that we can take a quick look at it and know where we stand, but also a banker or an investor or anybody who has interest in our business can look at it and know about the financial stability and soundness of our operation. The first one is an income statement. One of the important things to learn about an income statement is that the income statement is typically for one fiscal year. A fiscal year can start January 1 and end December 31st. That's the most common, but it can start at any other time in the year. So you could do a September 1 to August 31st. It's really based on your when you set up your business and what type of tax year you set up. But at any rate, it's 1 year or less, and it is, think of it as like your monthly statement of money in your personal accounts. So what money comes into you and what money flows out. So basically, it's a statement of all the revenues that flow in and all the expenses that flow out. Expenses can also be non-cash, but I'm not going to get into that because, for instance, an example would be depreciation. Because that's something that you'll learn in accounting. But just know that an income statement is basically a list of revenues minus the list of expenses, and the bottom line is either a profit or a loss. So sometimes the income statement is also called a profit-loss statement. The balance sheet refers back to our friend here, the accounting equation. And it is organized in such a way that it groups all the assets first, and gives you a subtotal. And then it groups the liabilities with a subtotal and the owner's equity with a subtotal, and then a subtotal of both liabilities and owner's equity. And that those two things combined, those two sections combined, should equal the subtotal you have for your assets. And this is a snapshot. It's of the financial well-being of your business. It is an ongoing statement. It is not for just 1 year. It starts the first day that you form your business, and it continues all the way through until the business is dissolved for some reason. So in other words, it is an ongoing representation of the value of your business and how your business is being funded. The last statement is a statement of cash flows. Think of this as sort of, how much money do I have in my personal checking account at any given time? Well, maybe it says I have $1,000, but I know that my rent is coming due in a day, et cetera, et cetera. So what it does, the statement of cash flows, is really an inflow and an outflow of cash, because we want to know from at any given time whether or not we have enough cash on hand to meet the operating needs of our business. And this is one of the reasons this is so important, is that many small businesses end up going broke because they run out of cash and they can't meet their immediate obligations in terms of expenses like payroll or rent or that sort of thing. So the statement of cash flows, think of going to an ATM and you'll see how much money you have, but in your head you're also subtracting out the obligations that are coming up, and maybe something that you just spent hasn't posted yet, so you have to take that into consideration too. That's a statement of cash flows. If you take all of three of these and put them together, then you're very likely to have a pretty good view of your company and its financial status. I mentioned in class that I would also give you a couple of answers that you'll find on the final exam, and the first of those answers is supply. So let's move on to short-term and long-term financing. One of the key things here that I want to iterate to you is that short-term is typically 1 year or less. Long-term is more than 1 year. And again, if you think of the income statement, that makes sense, because your revenue and expenses, your profit and loss, is really calculated on an annual basis. That's considered short-term. You'll see in the first bullet I have there that matching financing needs and matching the need for financing with the type of financing is very, very important. And we talked a little bit about this in class. For instance, if you're buying a home, you're probably not going to use a short-term financing arrangement of 1 year because it's way too expensive, and you're going to need long-term financing because it's a longer-term purchase. On the other hand, if you're buying some smaller items like clothing, for instance, and maybe it adds up to $300, you're typically not going to take out a 10-year loan on that because you'll be paying interest forever. And so instead, if you need to use debt, you're more likely to use a credit card or something that is much shorter term. So just remember that you want to use short-term financing for short-term needs and long-term for long-term needs. The second answer, by the way, in the final exam that you'll be interested in knowing is double entry. Double entry. Again, the terms debt and equity are also important to understand. Debt means an obligation to pay back. So if you when a company issues a bond, they are seeking a loan from people. A bond is a debt because they are asking you to loan them money and they're going to pay you back with interest. And so they float what we call a bond. A bond is a debt instrument. Equity is ownership, again, ownership within the company. And a piece of ownership is called equity. So it could be as a sole proprietor that you own the value of the things in your company, or you could be a shareholder, a stockholder, and own a piece of equity in a company. Kind of, I think, brings us to the end of the accounting chapter. Don't forget that the digital study module for chapter 15 is due 11:59 p.m. Sunday, December 3rd, which is today. We do not have any class next week, which is dead week, week 11. Instead, you should be working on your final, preparing for your final, getting your study guide taken care of in terms of coming up with some answers maybe to some questions, etc. Also, we will not be meeting in class face-to-face during finals week, so we no longer will see each other in the classroom. The final exam will be available online only. It is due 11:59 p.m. on December 12th, which is when we would have our normal in-class final. You should be able to see it by tomorrow morning, Sunday the 12th, December 4th. And that way you'll have more than a week to work on it. I did already notify everyone who reached the 90 or greater than 90% mark in their daily quizzes. They've already been notified, so if you have not heard from me, you must take the final. If you have questions, email me, okay? Everything to date is graded except the digital study module, which I'll go in and grade once you've completed it. And the study guide for the final exam is posted under week 11 and the content. To access the final exam, you can also, tomorrow when it's available, starting tomorrow, you can go into content on D2L, week number 11, and click on the link for the final exam. Or you can just go into the D2L shell and across the ribbon at the top, just click on quizzes, and then it'll give you a choice. You click on final exam. So I think that takes care of it. It's been a joy to work with you this term. You've been a really, really fun class. I've certainly had a lot of fun working with you, and I hope that you've enjoyed it as well. If you have any questions, please don't hesitate to get in touch with me. That's why I'm here. I'll be on my email a lot because I'll be grading papers and final exams in the next several days. Have a great holiday, and I hope to see some of you in the near future.